In the world of candlesticks, there are many different patterns. However, there are only a few that I've found to be very effective when traded the right way. In today's video, I will share two price actions patterns that stop, spot, reversal, and high probability signals, namely on the Piscean line and the dark cloud patterns. Piscean patterns is the candlestick formation formed near the support levels and it gives you potential bullish reversal signals. It is found towards the end of the downtrend and it quite similar to the dark cloud cover. The only difference is that dark cloud cover signals bearish reversal while pricing pattern signals is a bullish reversal. So Piscean line is the bullish reversal pattern that can be found on the end of the downwards. This candlestick's formation is used as the indication to enter a long position or exit the shell positions. Piscean patterns is formed when the bulls and bears both are fighting to gain control over the prices. The first candlesticks should be red candlesticks having a large real body, and the second candlesticks should be green and also should be below and the low of the previous candlesticks. Also, the second candlesticks must close above the middle of the real body of the first candlesticks. There is the formations of the price ring line. We see the market is in downward and the 7 activity predominates. Here is the first piece of our pattern with the bearish candles being formed. This bearish candlesticks is usually a big body candlesticks having a no or very small upper or lower shadows. The opening of the next candlesticks is below the closing point to the previous bearish candlesticks. Next, there is an increase in the demand by the bulls and the price starts rising. At the end of the day, because we are on the daily time frames, the bulls are successful in making the price rise and the closing price is more than the middle of the previous bearish candlesticks. Now you must look at 5 characteristics when you search for a price ring pattern. Firstly, the trend should be downward as the price pattern is bullish several patterns. Secondly, the length of the candlesticks plays an important role in determining the force with which the reversal will take place. Also, the gap down between the bearish and the bullish candlesticks increase how powerful the trend reversal will be. Fortunately, the bullish candlesticks should close more than the midpoint of the previous bearish candlestick. Lastly, the bearish as well as the bullish candlesticks should have large bodies. Here we can see that all of the characteristics mentioned for a trend reversal signaled by the by string pattern are fulfilled. They are downwards trend. We have a large bearish candles. We have a gap down between the two candlesticks and the bullish candlesticks close above the midpoint of the previous bearish candlesticks. When you see price line candlesticks patterns on the particular market, you could enter right away in the close of the second candles. If you could wait until the height of the first candlesticks is broken. The stop loss should be placed at the low of the previous bearish candlestick. This pattern is more suitable for swing trades as from my back testing the rate of success are quite thin in the lower time frames. The dark cloud covers in the opposite of the price patterns being two candlesticks patterns that is created when the red candles opens above the close of the prior green candles. The close below the midpoint of the candles when you spotted the dark cloud cover patterns on the Japanese candles chart, you expect a potential bearish reversal. To identify the dark cloud cover, you look for the following criteria. An uptrend must be occurring. The first candles is pattern is large bullish candles. The bearish candle must follow the bullish candles. The bearish candles must pass through the midpoint of the previous candles. It must open above the high of the previous candles, and it must close more than halfway down the body of the previous candles. Here are some tips to analyze your dark cover cloud pattern when you see one. The higher the gap is from the previous candle's close, the bigger the reversal will be. This shows that the market was unable to sustain that high price levels. The longer the bull candles and bear candle are, the more pronounced the reversal will be. The lower the bear candle goes into the bull candle, the stronger the reversal will be. If the volume is high on both candles in relation to previous candles, the ratio is more likely to occur. Also make sure that the dark cloud covers patterns you are seeing is not the bearish engulfing candles. They are very similar in appearance. If the second candle closes below the previous candle's opens, you have the bearish engulfing patterns, not a dark cloud cover formation. Here's an example. It starts with the bullish candles in the uptrend, followed by the gap of the next day. The candlesticks of the next day turns to be bearish candles. The close of these bearish candles is below the midpoint of the previous candles. The bullish and the bearish candlesticks have large real bodies with very short or no shadows, as in the case of the price link line pattern. You must look on a few characteristics when you trade with the dark cloud cover pattern. Firstly, the trend should be an uptrend, and dark cloud cover patterns is bearish reversal pattern. Secondly, the length of the candlesticks plays an important role in determining the force with which the reversal will take place. The gap up between the bullish and the bearish candlesticks indicates how powerful the trend reversal will be. Fortunately, the bearish candlesticks should close more than the midpoint of the previous bullish candlesticks. Lastly, the bullish as well as the bearish candlesticks should have large bodies. Before you can know how to trade the dark cloud cover price line pattern, it's important to know when to avoid trading it. While they are considering reversal candlesticks patterns that you don't want to do it to trade them without context. And what I mean by that is doesn't trade them every time they appear on your chart. When trading any candlesticks patterns, you want to see the context of its information. That means whatever there is any chart patterns that forms during this time, or whatever there is any support resistance values that makes sense for its formation. As with my any candlesticks patterns, you only want to trade then use the candlesticks pattern as the entry trigger. So how to exactly get into trade once the dark cloud covers appears? First, entry method 1. At the close of the dark cloud cover, the first type of entry is what I consider too aggressive entry. To enter into the trade using the entry method, you simply wait to the close of the dark cloud cover and then enter to the trade. That means once the second bar of formation close, you immediately go short using market orders. I consider this an aggressive entry because you don't wait to the future confirmation that the market will go in the directions of your trade. Future confirmations is to wait for the market to enter its break below the low of the dark cloud cover, or to close below it, and then leads us to the next entry method. The second entry method is to enter into a trade when the market breaks below the low of the first bar. The formations for this entry method, you could use a stop order. A stop order is essentially a market order, but the only trigger when the price reaches the trigger level that you set. So in this case, the trigger level is below the low of the dark cloud cover. When the market goes below the low of the order, will trigger the market order to sell the best available price. The top loss for both entries goes above the high patterns How to decide which entry method to use? Well, you decide which one suits you. Here are pros and cons of using each method. Entry method 1 pros can get a better risk to reward ratio for the same take profit levels, as much tighter stop losses than the other entry method. Cons get stopped out more often than the other entry method. For the entry method 2 pros, you have confirmations of the bearish momentum. Don't get stopped out as often as the first entry method. Cons: a worse risk to reward ratio than the first entry method. It's up to you to decide which entry method is more suitable for your trading style. To trade the dark cloud cover patterns, I look for pullbacks in a downwards. In a downtrend, the market will make lower highs and lower lows like this. These lower highs are pullbacks in a downtrend. What I'm looking for is the dark cloud covers patterns to form on these lower highs. But we don't want to trade every dark cloud covers that forms on the lower highs. We only want to trade the ones that are formed in the dynamic resistance levels. What is dynamic resistance levels? They are resistance levels formed by the moving average, more specifically exponential moving averages. So what I like to do is to plot two EMA on my chart. You can choose any lens you prefer, and what I'm looking for the dark cloud cover patterns that from on either of these EMAs like this. The opportunities is true for pricing line patterns. Here are other example of the pricing lines and dark cloud cover patterns on the different markets. Regarding time frames, you should look for hourly, 4-hour or daily chart for these patterns. From my back technique, the price lines and the dark cover are less significant in the lower time frames. Another tip to pay attention is to volume. If you volume high during the formations of the candles, there are more candles of the reversal to take place. Also, it's okay to confirm the signals given by other patterns with other technical indicators for safer entries. As always, if you want something new and found value, select show your support. Subscribe to our channel and click the bell to stay in touch when we upload new video. Until next time.